Dear friends and investors, welcome to our monthly video on markets and investments. So what are we going to talk about this month? We'll talk about four things: interest rates globally and in India, the PE contraction that we saw last year, how NSE 500 results are faring, and lastly, what trends did we see in the IT sector? Because many of the IT sector companies have already delivered their results. So let's start with the elephant in the room, which is interest rates. And why are interest rates important? Because interest rates determine the cost of capital. Rising rates means that your cost of capital goes up. And typically, you have an inverse relationship between interest rates and PE multiples in the market. But let's first come to interest rates. And we had the RBI, which did not raise rates. And we recently had the Fed or the US Federal Reserve, which increased interest rates by 25 basis points, but has indicated that for now, it has done with increasing interest rates any further. And therefore, it would be safe to assume that, broadly speaking, central banks around the world have probably done with all rate hikes. And that is very, very good news for all risk assets, but particularly for us, equities. The US interest rates, obviously compared to history, are way, way higher. And the repo rate has peaked out at 5.25. And in India, the repo rate has peaked out at 6.5. I think given the fact that the US banking industry is still very, very shaky, we've had two banks that have failed and a third bank where their assets were sold and JP Morgan bought them. But despite these three and the assurance from the Fed, the regional banks in the US continue to struggle and their stock prices continue to fall. And therefore, given this scenario, it has two implications. One, it is going to be extremely difficult for the Federal Reserve to go ahead and raise rates when the US banking industry is so shaky. And secondly, when so many regional banks are in trouble, you will see some level of credit contraction in the US, which means that the US economy will slow down. Whether it enters into a recession, how deep, we do not know. But one thing is certain is that the US economy will certainly slow down because of credit contraction. And if that happens, commodity prices will also come down, which means that inflation will also come down, and which means that there will be no need for any further rate hikes, and that's good news for equities. But before we get there, the implications of rising rates, as I mentioned, were very important. Last year, or actually since October 2021, when the Fed started to raise rates, what we saw was that there was a significant PE contraction across the board. And from 21 to where we are today, while earnings have grown, but if you look at the data of about 320 odd companies, you will see that only in 26 companies did we see an EPS downgrade but a P expansion. In 33 companies, we saw earnings go up and PEs go up. In 63 companies, we had earnings go down and a PE contraction. But most importantly, we had 200 companies in which earnings were upgraded, but the PE multiples contracted because interest rates were rising from end of 21 to all of 22 and the early part of 23. And that is one of the major reasons why quality companies, which typically tend to trade at higher multiples, corrected last year. And we've talked about this in the last few months, that 2022 was a very different year. Because of rising rates, you had PE contraction. And because of rising commodity prices, because of the Russia-Ukraine war, we had a big dip in margins. But in 23, we think both these adverse factors will turn around and help the equity markets. And if you look at the earnings which have already been announced so far for the fourth quarter, and if you look at the top 500 companies, about 118 companies have declared results out of the top 500 companies. And the trends that we see are heartening. While revenue improved 3% quarter on quarter, EBITDA was up 9.9% and PAT was up 16%. If you look at the non-financial companies, if you just take away the banks and the financials, and if you look at the 79 companies out of the 420 companies, top line has grown roughly by about 1.6% quarter on quarter, which is compared to October to December, the Jan to March is higher by 1.6%. However, EBITDA is up 13% and PAT is up by 25%. Now, if you remember, a couple of months ago, we had given you similar data for the first 3 quarters. And to recap what we had said at that point in time, we told you that from April of 2022 to December of 2022, which is 3 quarters, out of the top 500 companies, if you remove 80 odd financials, if you look at the balance 420 companies, we had seen a 30% top line growth, but we had seen a 25% fall in profits despite top line growing. And that happened because we saw a 5.5% reduction in EBITDA margins as a result of rising commodity cost, raw material costs, energy costs, power costs, shipping costs, logistics costs. And that substantially impacted the profitability and you had negative operating leverage. However, there is a good trend in the March quarter results where we have seen that even though top line has grown by only 1.6% quarter on quarter, but margins have expanded by 1.9%. So the 550 basis point of margins that we lost in the first 3 quarters of the year, we've now made up 190 basis points out of that 550 basis points, we've got it back, which has resulted in a positive operating leverage, which means that profits are growing faster than top line. And despite a very tough markets in February and March and all of last year, the markets in April have responded very, very well. Yes, there were some technical factors. In February, the sentiment was impacted because of the Adani issue. In March, the sentiment was impacted by US bank failures, rising rates, and the fact that tax breaks on large insurance policies and debt mutual funds were taken away. And a lot of liquidity in March was taken out of the equity markets and flew into buying insurance policies and investing that liquidity in debt funds, because after 31st March, the tax breaks went away. So that put substantial pressure on the equity markets. But come April, the market breadth has improved dramatically. The sentiment has improved, while US bank failures still are continuing, and that may continue to have volatility in the market. The improvement in profit margins has significantly helped the sentiment and the profitability, and markets typically tend to reflect earnings growth. So we believe that barring any large significant upheavals like we saw in 2022, 2023 should be a much better year for equities, because simply put, we will not see any more PE contraction because interest rates have topped out, broadly speaking. And as commodities have corrected, we are starting to see improvement in EBITDA margins and hence on PAT and EPS growth. And therefore, this year should be reasonably good, where we should be able to see that returns should mimic at least earnings growth, even if we don't pencil any PE expansion going forward. Hopefully, there is not going to be any contraction in PE multiples because there is going to be no increase in interest rates. But profit growth should logically mean that your market returns should mimic profit growth. Coming to the last point on the IT services sector or the tech sector in India, while there are still a few companies which have to declare results, many of the large top IT companies have already declared their results, and some of the mid-sized companies have also declared their results. And while Infosys was particularly bad, and so was Wipro, TCS did okay, HCL Tech did okay, but the trend is very clear. If you look at the quarter-on-quarter growth, Infosys was minus 3.2, TCS was only 0.6 plus, Wipro was minus 0.6, and HCL Tech was minus 1.2, and LTIMindtree was 0.7 plus. So either they were flat or negative, and the EBIT trend was also flat to negative. But as we've said consistently, that the ER&D companies, which is where we are invested, despite a very, very difficult environment for IT services, did phenomenally better. For example, KPIT had a positive 12% Q on Q growth and a positive 17% profit growth. Persistent had a 4% Q on Q revenue growth and a 4% Q on Q profit growth. Tata Elxsi has still to show results, but we believe that it should also have a positive trend on top line as well as on bottom line. So our hypothesis that we need to differentiate in the IT sector, the big general IT services companies are definitely seeing headwinds from the global macro environment and may continue to struggle for another quarter or two. But the ER&D companies seem to have escaped any significant slowdown and have delivered far superior growth. And that is also one of the reasons why their stock prices are at or near their 52-week highs or have done far better than the general IT services companies. And therefore, we believe that if the US goes into contraction, it may take 1 or 2 quarters for the general IT services companies to bottom out, but the ER&D companies should continue to deliver superior growth, superior profitability, and superior stock price performance. The earnings season is still underway. As I said, most of our portfolio companies have done in line or better than expectations. And that gives me a lot of confidence that by the time the earnings season is over and next month when we come back, we will let you know which of our companies have delivered as per or better than expectations and which are the ones which did not. But for now, the earnings trend look to be positive. The markets have responded well and the sentiment has improved substantially. We do believe that the rest of the year, barring any unforeseen large events, should be very, very positive for markets in general, but more particularly, our portfolio should deliver solid returns and recover from some of the setbacks that we spoke about last year as a result of P contraction and margin contraction. So with that, thank you all. Until next time.